All right, guys. So, welcome to the Tamid Fund educational series. I don't really know what to call this. I haven't given that much thought. Basically, to just introduce what's going on here, we've had a lot of people ask for basically just A to Z, everything about finance that we talk about in the fund. And so, what we're putting together right now is this video series. We're going to send out a part each week and over the course of the semester, and maybe even a little longer. We'll start from very, very basic accounting stuff and we'll go very, very deep into heavy valuation. We'll go into market mechanics. We'll go into all sorts of things that get very, very deep into the fundamentals of finance and into, the real systems that people in all areas of finance, from the hedge funds to the investment banks to, your typical investment advisors really use to advise their clients on. And so the way we're going to approach this, and I apologize if there are times already where, it might seem like I don't exactly know what I'm going to say. That's because I'm going to intentionally let myself go on a few tangents just so that we can go in depth. And because I think lots of people will learn the cookie cutter stuff in some of their finance classes, and I really want to add some angles that we might not otherwise really have. And so I'm just going to tell you the basic framework. We do have a basic curriculum that we're following, but again, the general framework is that we're going to be focusing on these three topics, right? And these three topics right here are accounting, valuation, and markets. And if you look at these and you say, well, isn't there a lot of overlap between the two? You'd be entirely correct. There is a lot of overlap between the two, but or between the three different topics here. But how I'm going to explain it in a second, you'll really see that they start to merge with one another and really it flows very nicely. And so I'll show you why right here. Because if you look, accounting, valuation, and markets, so what do each of these, what do each of these topics really represent? So if you look at it, let's go to the next page over here. The accounting really asks a simple question, which is what's happening? You account for assets and where they come from, and we'll get into those definitions soon. And again, if you already, lots of you, most of you will already understand what we're going to talk about at the beginning here, so feel free to listen and watch anyway. But really, we're going to timestamp this or just release it in different videos such that you're able to really only focus on what you don't yet know. Because basically the idea of this, this whole series is to bring everyone up to the same level instead of taking time in fund when we're all there to really just start at the lowest common denominator and work our way up. Instead, we're having these video series which will really try and bring everyone up to speed without taking up time during fund. And again, if any of you have questions, feel free to reach out to me. I'm always here to help. If I'm going too fast, if I'm going too slowly, just really, really let me know. If you can't understand what I'm saying, please call me out on it. And then in the remainder of the recordings, we will really, really do our best to take that into account, that feedback. And so, okay, back to the curriculum. So basically, this is the general outline: accounting, valuation, and markets. Accounting asks the simple question, what's happening here? We have these things, we're going to call them assets. We don't know what that means yet, but we have these things, what's happening to them? Okay, valuation says, okay, we have these things, we know what's happening to them, but how much should I care? So see how that flows from accounting to valuation? Without accounting, you can't have valuation. And that's the first key focus that lots of people have. And some of you who are just like Ace, I know lots of you are big Warren Buffett fans. And so Warren Buffett really says that the most important class you can take in college is accounting, especially if you're going into finance, because not only does that teach you how to manage your personal finances, and we're going to get into some personal examples of accounting in your own life, whether or not you want to be an accountant, but also it really teaches you the fundamentals of valuation. If there is no accounting, if you don't know what's going on, you have no idea how much anything's worth because you don't even know what's happening. You don't even know where to start. So accounting is really square one for all of finance. And so, but once you have valuation and you know how much should I care about this, right? How much is it worth? Then you have the question, okay, well, if this is worth something, what does that mean? If anything is worth something else, it means somebody else must be willing to pay that. And so that means that you have to set up a market. Otherwise, it's not really worth anything. So you set up the market such that you can really prove that you care the right amount. And if you think you care about an asset more than someone else does, you're willing to pay more for it. And so you go to the market and you drive up the price a little bit. And so here's just basic markets 101, right? Every vote, and we're going to get into this much more in depth when we get to markets, but every bid and every ask in a market, right? So basically a bid in a market is how much do I care? if I care about this enough that I'm willing to pay $2 for something, that's a $2 bid. And the opposite is also true, and that's called an ask. So an ask says, if I care about this for $2, if someone offers me more than $2, I'm willing, so $2.01, then I'm willing to sell it to them for that much. That's called, so the ask is $2.01. And so basically every time someone bids on an asset, it's kind of like a bid like in an auction. Every time someone bids on something, it's a vote for the price to go up. And every time someone asks to give up the asset in exchange for money, it's a vote for the asset's price to go down. And so basically it's this whole flow chart from accounting tells us what's going on, then valuation tells us how much do I care, and then the markets say how much does everyone else care. Basically prove it that I care the right amount. Put your money where your mouth is. And so we're going to start at the beginning with accounting. Accounting is going to be accounting's a lot. There's a lot of stuff, but we're going to try and get through it pretty quickly because the truth of the matter is, even though accounting is square one for finance, accounting, you don't need to go in depth in accounting to really understand most of finance. And so we're going to go in depth a lot maybe later on, but right now we're going to get really just, what we need for fund, and just so you know what everyone else is talking about. And really, this stems from three primary statements. Okay, and these three statements are the accounting, are the fundamentals of accounting that are most important for finance, and I'm sure most of you guys can already guess what they are. So the first one is what's called a balance sheet. Okay, the balance sheet basically shows what's called the fundamental accounting equation, right? Which is simple assets equals liabilities plus equity. So what's going on here? What are our definitions? Lots of people might think they know what an asset is, or they might know what a liability is. I'm sure lots of people do, but lots of people don't. And so an asset, people define really loosely lots of the time. But there's actually a real definition for an asset. An asset is not just something you have, okay? If you just have something, I'll give you an example. Lots of people think that a diamond ring is an asset. And for some people, it might be if you want to go sell it on the secondhand market. But if you just buy a diamond ring to hide under your pillow for 1,000,000 years and you're never going to use it for anything, then arguably it's not an asset, because you might say, even though this is worth $10,000, if I never want to sell it because it's worth so much to my family, and so even if we're starving to death, I'd rather starve to death than sell it, then it's really not an asset. Because here's the rule for an asset. An asset is anything which has the potential to make you cash. So anything which has the potential to make your cash balance go up. And so for example, if you say, well, I have this diamond ring or this diamond necklace, and I'm thinking about selling it potentially, or I'm thinking of taking a loan out against it potentially, then it would become an asset, because then it has the potential to make you cash. Okay, then what's a liability? You might be quick to say that a liability is the potential to lose you cash, and you'd be close, but you'd be wrong. Because here's the thing. The difference between an asset and a liability here is an asset is anything that has the potential to make you cash. And here's the first bit of lumdus that probably most people don't really understand about this basic accounting equation. And that is this. Assets are anything that has the potential to make you cash. Okay? But liabilities are anything that will liabilities are anything that is guaranteed. I'm definitely going to spell this wrong. That's okay. Liabilities are anything that's guaranteed to cost you cash. That's a huge difference. Because what's this essentially saying? This isn't just an equation now. Now this has intuition behind it. What's the intuition behind this definition of assets and liabilities? The intuition is assets have the potential to make you cash, but they might not. I'll give you an example. If you buy a stock, right? A stock is just one share. A stock is a way that a company is divided into shares. If you buy one share in a company, one share of a stock, right? That means you buy a small part of this company. And when you buy this part of the company, its value can either go up or down. So it can cost you cash or it can earn you cash. But it's not guaranteed to earn you cash, and it could cost you cash. Okay, so then you could be saying, if you just said, well, listen, an asset has a potential to make me money, a liability has a potential to lose me money, not money, cash would be the better term, then you could say, well, if a stock can go up, then it's an asset, but if a stock can go down, then it's a liability. But this equation says, no, that's not true. Because as long as it has the potential to make you money, even if it has the potential to cost you money, it's still considered an asset. Okay, so now we have a liability. What on earth is a liability then? It's guaranteed to lose money. So here's another bit of lumdus here, right? Every asset you acquire has to come from somewhere, and that's what this equation says. Frequently, right? Equity we'll get to in a second, but frequently this comes from a liability, which means in order to have the potential to make money, you have to make cash, you have to take on a guaranteed loss of cash. Okay? And that's something that lots of people don't understand, right? In order to have the potential to make money, even though you could lose money, you have to guarantee that you're going to lose something in the short term. So that's just something that's a little interesting. But now, what here is equity, right? Equity could be all sorts of things, right? Equity could be an investment from a venture capital firm. It could be investment from the owners. It could be a bunch of things. But basically, equity is a filler from investors. So whatever assets don't equal liabilities, equity is basically what's left over for the owners of the company. And so we're going to get into that later on a lot more. But right now, so that's the balance sheet. Now we're going to talk about the other two statements really quickly, and then we're going to go into details on basically the different types of accounts under assets, liabilities, and equity. So let's go into next. Okay. So what we're going to go through here is something called the income statement. The income statement, I'm sure you're all familiar with, at least to an extent, right? An income statement is very simple. And it just shows, I mean, once you get to specific companies, then it gets into really interesting details because every company's accounting practices are a little bit different. But basically what we have right here is the income statement. And the income statement says, look, we have this amount of revenue, right? But with this amount of revenue, we also have this amount of expenses, right? And so if we have revenue minus expenses, it should give us our income, okay? And that's the basic income statement. But let's take that aside for a second. Okay, that's the most basic income statement. But let's get rid of that. And then let's go a little more into detail. What would be in an income statement? We should still start at revenue because revenue just represents the money coming into the company, but it's a specific type of money coming into the company, which we're going to get to later when we go more in depth into it. And then you want to subtract, because what type of revenue is it? We'll get into a little bit now. So the type of revenue coming into the company is the revenue which the company earned through its core business practices. Okay? If a company earns, for example, interest on a loan, that doesn't count as revenue. If a company earns, so core business operations is one broad term, but there's a more specific way we can say it. There are two rules for what can show up on an income statement. Okay, it has to fulfill these two criteria. You know what? Better than rules, two criteria for something to show up on the income statement. Okay, these two criteria are, number one, it has to be related to the current time period. Okay, because an income statement shows revenue from time X to time Y. Okay, from maybe January 1st to December 31st, from maybe January 1st to March 31st or 30th. I should know my months by now. Okay, but you get the point, right? Meaning revenue is over a period of time. And so in order for something to be on the income statement refers to a specific period of time. It has to be relating to the current period. Okay, that's number one. Number two, the second criteria for something to be on the income statement is that it has to be tax deductible. Okay, why is that? Well, it's somewhat arbitrary here, but the truth of the matter is, when you get to your income at the bottom, that's what we call your taxable income. And so your taxable income basically just says, here's how much income you've made on which you have to pay corporate income tax. And so you only have to pay corporate income tax on the things that have been done during that time period. So of course, basically, if you think of the income statement as a list of what you have to pay taxes on, or what you have to pay income taxes on, it makes sense. If you have to pay income taxes for 1 year or for 1 quarter, it's only going to mark the revenue and expenses associated with that 1 quarter. Okay, so there are lots of different nuances that go along with that we'll get to later on. But basically, that revenue has to do with revenue that comes from what the business does on a regular basis, primarily. Okay. And so if a business sells paintings and they make $1 million from paintings, but they also made a loan to someone else and brought in $10 of interest from the loan, that loan, well, first off, it's not necessarily related to the current tax period, and third off, it's not deductible. So that's basically how you think of it. We'll get more in depth into that later. Don't worry about what I just said. That was off topic. Okay, revenue is what you get from the core business practices. Now there's another thing called cost of goods sold. Cost of goods sold basically tells you what are the expenses associated with this specific thing, right? So if I'm a painter and I sell my paintings for $1 million, but the materials cost me 500,000, then my revenue would be 1 million. I don't know why it doesn't work outside the line here. Okay, then my revenue would be 1 million, and my cost of goods sold would be 500,000. Okay, but here's the thing. There's also other expenses. So once you say revenue minus cost of goods sold, that's going to give you your very basic, what's called your gross profit, or some people call it your gross, some people call it your gross margin. Okay? So basically what that is that's saying, look, if all we had were the costs directly associated with creating our product, in other words, the costs of the goods sold, or COGS, and all we had on our income was the revenue made by this stuff, how much money would we make? So when you hear people talking about margins, like it costs us $10 to make, this random thing that we sell for $30, then their gross profit or gross margin per unit is $20 because it's the $30 of revenue minus the $10 of cost of goods sold. Okay, is that starting to make sense? So now, I'm just abbreviating this so we have more space. Gross profit / margin, okay? So gross profit / margin, it gives you one number. Then you have to subtract other stuff. And these other things that you have to subtract, well, if they're not the direct expenses, right, then they must be different types of expenses. So we could call them operating expenses, or OpEx for short. So operating expenses are all the expenses that a business has to usually pay that aren't directly associated with the cost to produce an object. For those of you who are familiar with microeconomics, right, the marginal cost of a unit, right, is not the same. Sometimes you have a lot of upfront costs, right, fixed costs and marginal costs. So if you want to think of it like that, if you've taken econ yet, right, OpEx, operating expenses, would be kind of like your fixed costs, which don't change based on the number of units, or they change or they don't change based directly on the number of units. And then your marginal costs are going to be your costs of goods sold. And so all we're doing is we're translating marginal costs and fixed costs into accounting terms. And we're saying, look, marginal costs are for each marginal item we produce, it costs us this much in cost of goods sold. Fixed costs are just costs we have to pay. Okay, so what are some examples of operating expenses? Well, this we could say breaks down into two main things. I would call it, one of them is called S, G, and A, and one of them is called D and A. D and A. So those are the two most common operating expenses, but you're going to see lots of different things. So what do these stand for? What do they mean? SG&A stands for Sales, General, and Administrative Expenses. So that's pretty much exactly what it sounds. Sales, General, Administrative Expenses, right? So that's, paying for your office space, paying salaries, marketing expenses, all that sort of stuff. That goes into SG&A. And then there's also D&A. D&A is a totally different kind of operating expense than sales, general, and administrative. Sometimes depreciation and amortization is not even considered an operating expense. That really depends on the way the company accounts accounts in its books. But basically, depreciation and amortization refer to something called the useful life of an object. So what's the useful life of an object? The useful life of an object is how long something is considered valuable for tax purposes. And so sometimes these things are at the discretion of an accountant, and sometimes these are an auditor, and sometimes these things are at the discretion of federal tax codes, which basically say, for example, I think a car's useful life is 5 years, a building's useful life is 30 years, which means that for every year you own an object, you're able to deduct a certain amount of that object's value from from your taxes. And so the reason you're able to do that is because they say, look, we have these two criteria for the income statement. We know that it has to relate to the current period. We also know that you're able to deduct your expenses on your taxes. So if something lasts more than one current period, a car might last you 5 years, so each year it's current, right? You don't want to deduct all of your car at once because it's going to last you more than 5 years. So it wouldn't be fair because then what people would do is if they wanted a huge tax break, they would buy a really expensive asset. Like they would buy a really expensive thing like a car, right? And once they buy the car, then they would deduct the whole expense of the car on their tax bill. And then right away they would sell the car. And then once they sell the car, they would get the money back right afterwards. They just dodged a big tax bill for another year. And so the government wanted to put an end to this. And so what did they say? They said, look, if a car lasts you on average 5 years, you can buy a car, and every year what you can do is you can deduct a fifth of the value of the car from your tax bill because it has a useful life of 5 years. And so this is something that we call straight line depreciation. We're not going to get so into the different types of depreciation because it's not so relevant for fund. But just so you guys know, there are different types of depreciation. Some assets depreciate faster than others, kind of like a curve where it depreciates a lot at the beginning and then slows down. Some of them the other way around, don't appreciate right away and then appreciate at the end. So it's no, I'm sorry, that's not how that graph should look. Some of them here we go, don't appreciate at all and then go at the end like that. So depreciation curves can be very interesting, but the one I was telling you about with the car is straight line depreciation, which looks like that. And so basically, depreciation says, look, which portion of the car or of the asset you purchased has a useful life in this current period? So if this current period is 2020 and a car lasts 5 years and you bought it in 2019, then 20% of the car is being used during 2020. So that's how much you can deduct for tax purposes as your operating expenses, or some people just have it as its own line item on the income statement. So that's an example. People do that with buildings over 30 years where they just divide the value of the building by 30. But that's where you get into, okay, different types of things. Okay, so basically these are the most common operating expenses. And then once you get to that, right, let's see. Okay, so we understand this criteria. Let me just erase this real quick so I can write a smaller version and get more room. Okay, 1 second. But I hope you guys understand. I'm going to keep up the two criteria here because these are really, really important. Whenever you think of should something go on the income statement, think of it this way. Does it bring the company money or cost them money? Right? Because is it something at all that we would consider on the income statement? And if so, does it relate to the current period and is it tax deductible? So that's something that's very, very important to just ingrain into your head. Okay, so now we're going to just write this smaller. Okay, that's still in eraser mode. Okay, back to line. Okay, here we go. So revenue minus cost of goods sold gives you your gross profit or gross margin, right? And then subtract that from your operating expenses. And now we're left with that could possibly be SG&A. It could also be depreciation and amortization. Okay, and now what are we left with here? We're left with something very important called your operating income. I'm sorry. How should I put this? Okay, you know what? We're going to do it this way. Here's the most common way you see it, okay? Sometimes, okay, technically, depreciation and amortization are indeed operating expenses. However, most people don't usually include depreciation and amortization as an operating expense. Most people put depreciation and amortization as its own line item. And that's because they want to add something else right here. What do they want to add right here in the income statement? They want to add something called EBITDA, which sounds a little weird. Deal with it. It's talked about all the time. Okay. EBITDA. So what on earth is EBITDA? So it's an acronym. What does it stand for? Okay. EBITDA stands for earnings. Writing this one down because it's long. Earnings before interest, taxes, and you're going to ask, like, why on earth does this matter in a second, and we'll get right to that. Earnings before interest, taxes, depreciation, which we just spoke about, and amortization. Okay. So what's going on here? Why do we care about this? So first off, I realize now that I forgot to explain amortization. So amortization is just depreciation, but for non-physical assets. So if depreciation is for cars and trucks and houses and buildings and all sorts of things and like big machinery and stuff like that, if that's what depreciation is for, then amortization is for things like patents, which wear off in 20 some years, things like that. Basically, things which have a useful life of more than a year. However, they aren't physical assets. Some people call them intangible. Tangible is just a word that pretty much means physical. Okay, so now back to EBITDA. So why do we care about this acronym EBITDA? Earnings before interest, taxes, depreciation, and amortization, right? To be honest, in its and of itself, it doesn't mean all that much. However, people care about it because it's very, very similar to something called free cash flow. It's not that similar, but it's the quickest estimate you can get to free cash flow, or FCF, free cash flow. Okay? And free cash flow basically says how much cash, we understand income can be coming into the company, we understand expenses can be going out. But sometimes expenses are accounted for before they're actually paid, right? Because there are two types of accounting. And so I know this is a little bit disorganized, but there are two types of accounting. There's what's called accrual-based accounting, and there's what's called cash-based accounting. Okay? Accrual-based accounting says you mark every expense and every income and every revenue. Okay, you mark that when you've accrued it, which means once you've committed to it on paper. Once you've signed the deal, that's when you mark it down. Once you agree to pay X amount or to be paid X amount, that's when you mark it down. That's accrual-based. And that's what we use most of the time nowadays. Cash-based accounting just says how much money is coming into the company on a practical basis. Because even when you have accrual-based accounting, you still need to be able to eventually pay your bills in cash. So you still care about cash. And if you're a shareholder and you want to liquidate some of the company, which means you want to take some of the money that the company has out and into your personal pocket, you need to know how much cash is this company generating and can they survive it. So ultimately, what really matters with any company is how much cash it's generating. Because you could be bringing in all the revenue in the world and you could be going broke. I'll give you a simple example. If I were to promise you all $1,000,001, right? I'll give you $1,000,001. I'll sell $1,000,001 to you for $1,000,000. So you pay me $1,000,000, I pay you $1,001. So if I do that 1,000 times, right? My revenue is $1,000,000,000. I'm $1,000,000,000 company. Fine. But my expenses are $1,000,000,000 1,000. So I've lost because I had to pay out more to you. So it's really easy to generate revenue, but I still lost $1,000 in cash. That's a business I could set up today. Anyone would join it. I mean, anyone would be a customer because you're just getting free money, right? So anyone would be a customer to that business. That's $1 billion business. We can all start today in terms of revenue, but it's losing cash and it's not making anything useful. It's a terrible business, but it's $1 billion business. We could all start today, but we don't really care about revenue. We care about cash. And so that's, I don't know, I think this is the most applicable use of the saying cash is king, as opposed to just when people say like cash is king so they don't invest and miss out on opportunities. But we'll get into that much, much later on. But basically over here, accrual basis accounting is how most people account because that's what's used in what's called GAAP. GAAP is an acronym that just stands for Generally Accepted Accounting Principles. What are generally accepted accounting principles? Generally accepted accounting principles are basically the laws which standardize how public companies have to keep their books such that investors, as well as people within the company, and as well as regulators, and really everyone else, can see what's going on in a standardized, uniform way such that they actually know what they're talking about. And so GAAP, which is the way that all public companies, at least in America, there's a different standard called, I think it's IFRS. We're not getting into that, but that's for international companies. But when it comes to American companies, GAAP, the generally accepted accounting principles, are what's used to report earnings and to report these three statements which we're talking about. And so that uses accrual basis accounting, which basically says that we're going to mark every transaction when we agree on the transaction instead of when we actually pay for it, because that might not be at the same time. You might agree on a transaction. For example, if any of you have credit cards, once your statement ends, you have 30 days to pay the bill. So accrual-based accounting only marks the bill once the statement ends, but cash-based accounting only marks the bill once you actually pay it. And so those are the differences here. There are practical benefits to accrual-based accounting versus cash-based accounting. For example, if someone owes you money that they haven't yet paid, there's no real way to account for that and to keep track of that in cash-based accounting, but there is in accrual-based accounting. So that's something that that's a real practical benefit. That's I think what the biggest practical benefit would be of accrual. Yeah, there are just ways to mark for owing money, which you don't have in cash-based accounting, because in cash-based accounting, there's no such thing as really owing money, right? You can borrow money, but you only account for the borrowing of the money once the money's actually switched hands to be borrowed. You can't say, well, I'm going to give you this good or service, you can't, and you have to pay it back 30 days later. That's very tough to keep track of in cash-based accounting. And so that's why accrual is better for, practically. But cash is much better for owners because you want to see, listen, do I have enough cash to pay my bills? Do I have enough cash to take money out of the company if I want? Another word for that is liquidate some of the company. Okay, so earnings before interest, taxes, depreciation, and amortization, which is exactly, what does it mean? It means exactly what it sounds. It means how much have I earned before deducting my interest, my taxes, my depreciation, and amortization. Okay? And what's the same thing about all of this? Right? Lots of this stuff, right, doesn't have to do with cash. Right? For example, depreciation and amortization are not cash expenses. They're things which you expense, right? Because whenever you deduct something for tax purposes, you are also expensing it, right? So something that's tax deductible is also expendable. You're billing an expense, okay? So depreciation and amortization are what's called non-cash expenses. Why is that? Because you've paid for the car up front, you've paid for the building up front, you've paid for the patent up front, whatever it might be that you are depreciating or amortizing. However, you're not deducting the expense all in the first year. You're deducting the expense over a period of time. So any time that's not any time that's not right away, you would have paid the cash in a different period, so you're not losing cash, but you're expensing it now for the sake of your taxes. So it's a non-cash expense because the cash was dealt in a different period. If you remember, if we go back to the previous page, right, everything has to relate to the current period. So depreciation and amortization, right, they refer to the current period, but the cash was all paid in the initial period because you bought it up front. So that's why it's a non-cash expense. Depreciation and amortization are non-cash expenses. Okay. interest that you have to pay, taxes you have to pay, those are cash expenses, but they're not a lot. It's not a ton of stuff. So people, what they do sometimes is they look at, and this is one of the reasons I'm not such a huge fan of EBITDA, just because people use it really as a proxy for free cash flow, and because it's a standardized proxy for free cash flow, because it's something that people often report with GAAP. I don't remember whether or not it's required with GAAP, with the generally accepted accounting principles, just to remind you guys of that acronym. But I think it is required. I don't remember that. Don't quote me on that. But yeah, it's a very, very commonly reported. It's very easy to calculate. It's quick, so people use it. Um, I don't I'm not a huge fan of it because it doesn't actually represent free cash flow. So who cares really if um who cares what EBITDA equals, even though it's standard? Who cares if it's standard if it doesn't tell you anything useful? Like if it's just an estimate for free cash flow, they call it a proxy. What does that really mean? So that's why I'm not a huge fan of it. Um, Warren Buffett is famously not a fan of EBITDA because he says it's not even close to an estimate of free cash flow because of something called capital expenditures. Capital expenditures are when you buy something which you are going to depreciate or amortize. What does that mean? Capital expenditures, or CapEx for short, people call it CapEx. Capital expenditures are basically when people have to, when people spend money on something that's going to last more than just the current period required on the income statement. So if the income statement's current period is 1 year, but you're buying a car which is going to last you 5 years, that's what's called a capital expenditure. So because it lasts you 5 years instead of just the 1 year, the capital expenditure is not on the income statement because it does not have to do with the current time period, and it's not all tax deductible right away. What is tax deductible? The 20% that you're allowed to amortize or depreciate right away. That is tax deductible, and that's the portion of your capital expenditures which are utilized during this current time period. So if that doesn't make sense, you can go back in the video a couple seconds. But the idea is, listen, anything that you buy which needs to be depreciated or amortized is called a capital expenditure. It's a big term for just assets that last more than the time period put on the income statement, right? Usually more than a year. Okay. So Warren Buffett famously says, like, he has a quote which I think is whatever. It's a quote that's thrown around a lot, probably overused, but it's, does management think the tooth fairy pays for capex? Basically, does management think that capital expenditures don't really cost you cash? It does. So how on earth can you use EBITDA to calculate free cash flow? And so it's a very controversial figure that people love to use because they're lazy and they don't really want to calculate free cash flow. We're going to get to calculating free cash flow. You guys will know how, and hopefully you won't be lazy about it. Okay, but basically back to our income statement. So that's also one of the reasons why people put depreciation and amortization on a separate line and not part of operating expenses, just because they want to be able to get this line item, EBITDA. And they think if they get EBITDA, that looks like a minus sign. I'm just highlighting it here. They basically think that if they have EBITDA, right, then everything's going to be okay, and it won't really matter. Whatever. It's not good. They want to get EBITDA, so they pretend depreciation and amortization aren't part of your operating expenses because they want to have it for free cash flow. Whatever. Okay, let's move on. So then you subtract, if you haven't already, you subtract your D and A. So this would be equal to EBITDA minus D and A. So we just cross out D and A. So what do we get when we do that? We get something called EBIT. EBIT is almost equal to something called your operating income. Because what's happened now? D&A is an operating expense. Depreciation and amortization, that's an operating expense, right? Right here. And then SG&A is also an operating expense. So once you've deducted all your operating expenses, you're left with your operating income. The reason EBIT and operating income are not totally identical, this should be a clear I. The reason they're not totally identical is because there are things which are not part of EBIT. There are other operating expenses, which we're not getting into here, but 99% of the time, EBIT is going to equal your operating income. Okay, So now subtract. So to finish off the income statement, this basically gives us a number that says, listen, from our core business operations, how much money are we making? Taking into account both our fixed costs, which are the costs of goods sold. Both our fixed costs, which are the sales, general, and administrative, right? These are fixed costs, as well as the long-term fixed costs, which are depreciation and amortization, right? That's another way you can think of it. SG&A is short-term fixed costs. D&A is long-term fixed costs because you need them both, and they're both part of operating expenses. So you could think of operating expenses as your fixed costs, and costs of goods sold as your marginal costs. If you haven't taken micro yet, don't worry about those terms. You'll get to them later. Maybe we'll get to them here. But basically, that's that. Okay, so now there are still a couple more things. Now we know, listen, we know how much money we're making when it comes to the core business operations of the company. But we're still missing out on one thing. What are we missing out on? We're still missing out on interest and taxes, these two things here. And that will really show us what's left over to the owners at the end. So if we take EBIT and we subtract interest, right, then we get what's called NOPAT. Okay, one second. Let me find a place to write this. Let's get rid of this. Got to finish this up soon because I have class, so hopefully we'll finish up the intro to the three statements. Okay. Here we go. So basically, EBIT. So let's start from EBIT here. We're just picking up where we left off. EBIT minus interest gives us what's called minus interest gives us basically our pre-tax income, right? Because interest is tax deductible. So if we have here, we get pre-tax income. And then everything left over after that, right? After we subtract our taxes, gives us something called net income. Net income is basically what's left over to the owners at the end of the day. And we're going to come back to that. So just to summarize this really, really quickly, and then I have to end this video before getting into the statement of cash flows and how these all connect with each other. But basically, here's the gist. Revenue, one second, here's the gist, okay? Revenue is what you make from your core business operations, subtracted by the cost of directly associated to what you're selling, gives you your gross profit or your gross margin, okay? That subtracted by your operating expenses, which is primarily SG&A, sales, general, and administrative, right? As well, that gives you, by subtracting that, you get EBITDA, which people use as a proxy, as an approximation for free cash flow. Subtracting D&A, you get your EBIT, which is an approximation, and most of the time it's accurate, for operating income. Okay, once you take EBIT, now we're up to here. Once you take EBIT, which is your earnings before your interest and taxes, and you subtract your interest, that's INT, that's what this says, you get your pre-tax income. Then adjusted for taxes, and you get your net income. Net income represents money left over to the shareholders at the end of the day. Money left over to the company to do whatever it wants with. And that's where we're going to deal with in the next lesson, after we deal with the statement of cash flows, and we deal with basically mushing all this together and telling you what do these statements mean with each other and what do they tell you about one another. That was a rhyme. Okay then. So I hope this was useful for people. I know this was a little longer than I had planned to spend in this accounting section. We're not done. We're probably going to have another one of these videos about accounting, maybe two. But we covered a lot. Now you should have a basic understanding of a balance sheet, what an asset is, what a liability is. We're going to get into equity later. And you should have a really good understanding of at least the basic fundamental outline of an income statement. And yeah, so I'll see you in the next one.